Hello and happy Thursday. Welcome to this Lunch and Learn. We have bi-weekly and our Empty Nester Facebook group. Today, we are going to be talking about making the most of company benefits. So very excited about this conversation. For those of you who are new here, this Lunch and Learn is brought to you by Purse Strings. We are all about providing financial education, tips, tricks, know-how for women. We want to get those wheels turning. But then when you're ready to, hire a financial advisor or, get your estate plan in order, planning for retirement, maybe you're going through a divorce, we have top tier financial professionals willing, ready, and able to serve you. We call those our Purse Strings approved professionals, and Stephanie today with us is one of them. So we're very excited to have you on today and talk about making the most of company benefits. But before we dive into all that fun, Stephanie, could you tell us a little bit about who you are and what you do?
Sure, absolutely. Thanks for having me on today. I appreciate it. So, hi everyone. My name is Stephanie Groschup, and I'm co-founder and managing partner at GM Wealth Group here in Dallas, Texas. A little bit of background about myself. I started in the business with Merrill Lynch actually back in 2001. So I've been around a while. Um, we started our firm in 2010. So, beginning in 2023, we'll be starting our 13th year in business for ourselves. We are a women owned and operated firm. So, we're very excited to be in this space.
Awesome. Well, we're very excited to have you on here today. And anyone who's jumping in, feel free to pop in any questions in the chat. If you're watching the replay, you can still pop in questions. We'll work on getting back to you on those. But before, let's just dive in.
Okay.
So is there any other background or information you want to share about yourself about you working in company benefits? Because I know you are a financial advisor, correct?
Yes, yes. And we do work in the company benefit space. We offer retirement plans of all sorts for corporations, large and small. So depending on, what the need is for the company, we'll offer everything from simple IRAs to 401ks, cash balance pension plans, and the like across the board.
Awesome. And so why is it so important to take part in company benefits?
Well, I know it sounds like a really kind of a simple topic, but it's really, really important that people pay attention to what's going on with their company benefits. And I think this is a timely topic because we're all in that open enrollment period right now. So we're planning our lives for the next year. And there are things that you should really pay attention to as part of your company benefit package. And I'm going to mention, some things that are going to be very general. Your company may have them, they may not. But we think it's important, first of all, to participate in the health insurance. That's pretty important. Protect yourself in terms of illness. That's very important. But also things like the life insurance and the disability insurance are also very, very important to participate in. And companies will have varying levels with varying costs for all of those things. But I think beyond that, beyond protecting yourself from major risk, there's a piece in the company benefit pie that's very important, and that's all about growing your assets. So things like the company 401k, things like, for example, your HSA account can also grow your assets. And I mean, health savings account. I'm sorry, talking in acronyms here. But things like that. There are also things that companies provide, and maybe not all companies have them, but a lot of your big corporations that are publicly traded, they have things like the ESPP, which is the employee employee stock purchase plan. And from time to time, you'll see companies give a discount on company stock. So that's a benefit to employees. So we see those discounts go anywhere from 10 to 15%. So that's, a good deal for employees. Other things that are part of pay packages as you get in the upper ranks of corporations, you see things like stock grants and options and deferred compensation plans. All those things are really, really important in building your net worth. I know that was a very long list, but
I mean, they're all great things, and sometimes we just think of, how much we get paid.
right.
If it's $100,000 a year, that's it. But really, there are these other things in there that really add to that pay. It might not be part of your paycheck, but it really adds to, like you said, your net worth and your overall wealth.
Right. That's absolutely true. And I'll tell you an interesting story. I have a friend who has a very successful coaching business, and it's for mid career women and up. And she was telling me about some of the people that come through her program that are very focused on career advancement and very focused on getting to that next salary level, but they've totally put aside all the other things that they could be taking advantage of inside these corporations that could help to build their net worth. Because it's not only about your income, it's also about your assets. So it's interesting to see that very myopic view until you make people aware of all those things that are out there that they can take advantage of to build their net worth, but also to take some tax advantages.
Yeah, definitely, definitely. And so, what are the pitfalls you were seeing, and kind of how do they affect people?
Well, it's interesting because just like that particular person that I was telling you about, this is happening across the board in some very large corporations where, and I think it's great that as women, we want to move forward and move up in companies, but we also don't want to forget about building our assets, because as women, we have some interesting situations that we go through versus men.
Yeah.
So, for example, we at times go through gaps in employment because we might stay at home to have a baby, or we might take care of an ill or an aging parent. So, those types of things, those gaps in employment could set you back in terms of net worth. I'm going to throw some facts at you here real quick, and let me just grab my piece of paper so I make sure that I don't make a mistake. But here's some things that, in terms of women, I think are very important in comparison to men. So we all know this, that women on average live longer than men. We all know as well, according to the Bureau of Labor Statistics, that women earn about 81 cents for every dollar that a man earns. In addition to that, the National Institute of Retirement Security put out this report, and it's interesting because the median retirement income for women is about 67% of men's retirement.
Yeah.
So that's, and I think a lot of that has to do with those gaps that we experience throughout our time through employment. But I think it's also because we leave things on the table in terms of company benefits.
Right, right. Yeah. We did just have this question kind of come through, and I know we
Mhm.
were just talking about all these opportunities of, stocks and options to buy. And
Mhm.
so if you have the opportunity to buy stocks or options, but what do you do if you have no idea how to manage that?
Well, I think the best advice I would give is to talk to someone that you trust, that's a financial advisor. Look for a financial advisor that you trust and has a vested interest in your success. So, someone who's just as interested in your success as you are.
Yeah.
But there are a lot of plans out there, and depending on, for example, you mentioned the options, there's different tax treatment as to what type of option that you have. So it's very important that you sit down and talk to someone about that.
Which I think is interesting because you never kind of think, oh, my company's offering some benefits. I should talk to my financial advisor.
Hmm.
Those don't always cross your mind, or talk to my tax specialist, but
Hmm.
those really do go hand in hand, and they're happy to help you out because overall it's increasing your net worth, it's increasing your assets, and that's what your, advisor is there to help you do.
Yeah, absolutely. Absolutely. And, back to the tax thing, I think that's a very, very important thing for people to really pay attention to in just the very basic level inside of a 401k plan.
Yeah.
Participate.
Yeah.
Every dollar that you put in that plan, you're not paying federal income tax on.
Wow. Yeah.
And we all know that tax deferred assets tend to grow faster than taxable assets just because you're not paying tax along the way.
Right.
So, we joke with our clients and we always say that, Uncle Sam is our least favorite uncle. But
That's a good one.
but, but it is true. Pay what you owe, but nothing more. So
Right.
let's try to find ways to build your net worth. And if you can save yourself some tax along the way, that's a great thing.
Right. Right. And so I know we were talking about some of these pitfalls that women fall into. And so how can we work on avoiding these?
Well, I think the first thing would be is to start early. So
Yeah.
if you're out of college and you get your first job, sign up for that 401k plan. That would be the first thing on my list. And if you're concerned about, how much it's going to affect your take home pay, look through that, do some calculations. What can you afford to put aside? And then increase it periodically. If you get a promotion or a raise, increase that amount that goes into the 401k. And you'll see a lot of companies, and I would say for the most part, all of them will do this. They will put in some sort of contribution on your behalf, whether it's a profit sharing contribution or it's a match. So if you're a person who's just starting your first job, put in at least up to what the company matches because you don't want to give away free money.
Right. Right. Definitely.
Mhm.
I even know that my retirement account, I just call it for 80-year-old Maggie, because I
That's
know
right.
if the money's in my account today, I can spend it, no problem. But if we take it out before the paycheck even hits my bank account, that'd be much better for me and my 80-year-old self later in life, especially if it is getting matched, because like you said, you don't want to leave money on the table. And sometimes that, a company that might do a 2% match versus a 7% match,
Mhm.
that's different at your compensation at the end of the day. I mean, that's a 5%.
That's right. It can be huge over an amount of time. When you start to see those assets build, you'll be surprised how quickly it goes when you're getting that company match. But that would be my first piece of advice is to start early because you have the benefit of time,
Right.
right? And the other thing I would say is save and save often. Be consistent because there's something called dollar cost averaging. And I don't know if you're familiar with what that is, but it gives you the ability to invest regularly over time. And you have the markets up, the markets down, but you can take advantage of those market fluctuations after you invest consistently. So I
Mm-hmm.
think that's one thing that you can do that's very, very important. And I know that things happen in life, and sometimes, you have a big expense come your way that you have no control over.
Yeah.
Try to find a way not to tap your retirement assets if you don't have to.
Mm-hmm. Definitely. Definitely.
Mhm.
And so, this group that we are talking to are empty nesters. So, of course, all of
Mhm.
them are of a certain age. And so,
Yes.
how can they take advantage of certain benefits? Are there anything specific that they should be looking at?
Yeah, well, there are a couple of things that you might want to look at in terms of company benefits. If you are still working, please do participate in that plan. Now, if you have other assets outside of your company plan, then when you get to a certain age, the government's going to make you take money out.
Yeah.
So that's called a required minimum distribution. And for people who hit age 72, that would be the trigger for that first distribution. Now, we are hearing that there may be some changes to the law coming where they could raise the age, but right now, where we are, it's age 72. So,
That's good to know.
um, unfortunately, you're going to have to pay tax on that money when you pull it out of a retirement plan. But in terms of company benefits, and if you are still working and if you're a certain level in your company, I want to circle back to that stock plan that we talked about.
Yeah.
A couple of things when you get to those manager levels and above, companies will be giving you stock grants, for example. So you'd want to talk to an advisor about those stocks because you're going to be paying tax on them because they're part of your compensation, but also it helps you to build your net worth. Then there could be a risk that comes down the road with having that company stock, and that risk could be something called a concentrated position. And what that means is if that company stock is bigger than all the rest of your assets, or is a
Mhm.
certain percentage that's large compared to all the rest of your assets. And in that regard, you'd probably want to talk to an advisor about helping you to de-risk your portfolio in that type of an instance.
Yeah, it sounds like you just at that point get too many eggs in one basket, and you want to kind of make sure you're not all with one company. As much as you love them, as much as you're working for them,
Yes.
you don't have all that control.
Yes, yes. And I'll tell you, I've seen that throughout my career. Um, an example when I worked at Merrill Lynch back in 2008. And you know what was going on back then? The market was heading down, and we were in a financial crisis at the time. And there were several people back then who had a large position in Merrill stock, and we saw it go from $97 to $3. So there is, that's very, very important to make sure that, yes, you build that nest egg, but also make sure you're not taking on too much risk because,
Yeah.
things do happen sometimes. So you want to make sure that you're de-risking that portfolio at the same time.
So that's a great point. It seems like that could be definitely more common if you've been at a company for a while. So you've really kind
Hmm.
of been accumulating their stock.
Yeah.
Yeah. And then I know you mentioned that one of the benefits could be either disability or long term care insurance.
Hmm.
And when you leave that job,
Hmm.
are you still covered?
Well, that depends on the plan that you have. And
Okay.
all those group plans are different. Some of them have what they call portability. So they will allow you to take, for example, I've seen some companies have long-term care insurance as part of a group plan, and then they have the ability to move that policy to another employer, to your own portfolio. We typically don't see that with disability insurance. Usually
Right.
those are not portable. So unfortunately, if that's something that you want to have access to and you feel like you might be leaving a job, you might want to contact an insurance provider and just make sure that you have coverage for that outside of your employer.
Yeah, that's a very common one I hear that, people think kind of travels with them, but it's only under that employer. And so, the day that you leave, it kind of disappears as well.
Exactly. And I think the same would apply for life insurance.
Yeah.
You see the average employer providing one times your salary. That's the typical one that you see. And then you can buy additional increments times your salary out of your
Right.
paycheck. But typically, if you leave that employer, the life insurance does not follow.
Mm. Yeah, those are good things to know just in case you do leave. Anything can happen the next day.
Yeah, absolutely. So I think it's important to make sure that you have all your bases covered
Yeah.
inside the company benefits. Another one that we didn't talk about when we were talking about your manager level and above type employees in large corporations, you see something called a deferred compensation plan,
Mm.
which will allow you to defer a certain amount of your salary of your choosing into a plan. Therefore, you're not paying federal income tax on it. Now, those plans are interesting because once you make a commitment to that, you have to stick with it for an entire year.
Okay.
Versus when you contribute to your 401k, you can increase or decrease in any time you like, unless your plan document says, they're going to limit the number of increases or decreases. But
Right.
you can make adjustments typically on demand inside of a 401k. But a deferred compensation plan, you have to make an election before the next year, and then you have to stick with that contribution all the way through 12/31. So that's something to keep in mind if something like that is available as part of your benefit package. They're good things to have, but just know you're locked in for a year once you make that decision.
Now, I'm not as familiar with a deferred compensation plan. What are the benefits of that?
The deferred compensation plan does not have a limit on how much you can put in it, according to most plan documents. I just want to
Right.
use that caveat. Some of them may put limits, but the vast majority of them that we see don't have a limit. So in a 401k, there is a limit that you can put in on an
Mm-hmm.
annual basis. With a deferred compensation plan, you can put a larger portion of your salary inside the plan or of your bonus inside the plan, and you won't be paying federal income tax on that money as that contribution goes. Then it grows tax deferred, similarly to a 401k, but you make an election each year on how you want to be paid that money when it comes out. Okay.
Oh.
So typical plans will have um, parameters on how that works. Some will say you can only take money out at separation from service. Either you quit, you get laid off, or you retire, one of
Mm-hmm.
those. Or they say it has to be in there for a certain number of years and then the money can come out. Just know that when the money comes out, you're paying tax on it.
Got it.
Okay. And then when you make your election up front, you have to say, this is how I want to be paid when the money comes out. And those typical choices are things like the money that I put in for this year, I want to take out in 8 years in a lump sum. So
Right.
that lump sum then becomes part of your income and you're taxed on it at that point. Or you can say, I want to take it out in quarterly payments over 3 years or
Mm.
monthly payments over 5 years. So you have some choices in that regard. But I think the biggest benefit of these plans is the no limit as to what you can put in and the tax deferred growth that goes with them.
Interesting. Interesting. Yeah, that's a newer one for me, but it does make sense.
Mhm. And one thing I wanted to mention too, and you'll see this in a lot of the plan documents for the deferred compensation plans, is that that money has to be at risk for the corporation for it to count as a tax deferred plan. So
Okay.
it becomes part of company assets. So if a company were to go bankrupt, then there is a potential that those funds would be part of that. So that's one of the things that you just have to pay attention to. But
Definitely. That's a great point.
mhm, but back to just make sure that you talk to an advisor that you trust and go through the details of your plan document so you can get some good advice on that.
Awesome. Awesome. Well, I feel like this whole session has been with a lot of great advice about how to use these company benefits and how to kind of make sure to stay on top of it. Um, is there any last tips, tricks, pieces of advice you want to make sure our audience hears today?
Well, I would go back to just say start early and be consistent. I think those things are really, really important. Pay attention to your tax liability.
Hmm.
If you can take advantage of programs that can defer income from tax, that's a great thing. So I think those things are really, really important. And the last thing that I would say is don't go it alone. Make sure that you talk to an advisor to help walk you through this and develop a plan so that you can meet your goals not only in terms of income, but in terms of net worth, in terms of assets, because they're both very, very important.
Yeah, definitely. I think the biggest thing I took away in this call is knowing that, like, bring your benefits plans to your financial advisor. That's not
Mhm.
weird.
Yeah.
Whatever options they're offering you all of a sudden, or any discounted rates, because they're happy to help you. Again, raise your net worth, however that looks, either through your paycheck or through some of these discounted stock options. So they're on your team. Make sure you have a good one.
Yeah.
Um, well, thank you, Stephanie, for coming on today. If anyone
Thank
else has any questions, they can email Stephanie. Her email's been going through the bottom here. She's also one of our Purse Strings approved professionals, so you can check her out on our site, pursestrings.co. And we will be back here again in December with some more Lunch and Learn. So thank you for everyone for tuning in, and we'll talk to everyone soon.
Thank you, Maggie.
Of course. Bye bye.
Bye bye.